I mean, you have to be a little careful about I've used the label, but obviously if I was investing, I'd be looking a little beneath just broad brush big tech, because there are a number of different stories and firms, and they're at different stages of their company life cycles, and they're also at different valuations. So notwithstanding that nuance, of course, the companies themselves have a role to play. I think a lot of the changes that we've seen in the last 9 months were extensions and accelerations of trends which were already in place. And I think a lot of those changes will be semi-permanent. In many cases, we won't go back to operating in the way that we did at the back end of 2019. Again, the question from an investment perspective, however, is how much of that is already priced? How sustainable are price earnings ratios of 100, 150, 200 and way above that? Certainly in some industries where the companies themselves don't have entrenched industry positions, they don't necessarily have huge amounts of IP, which is a barrier to entry for other firms, and therefore really you can't necessarily justify astronomical valuations on the basis of that particular position in industry. But I think, for example, shopping at a distance and working at a distance are something which we're going to see continuing to become increasingly prevalent, even if that's at a slower pace of change, a slower rate of change.
And on the complete other side of the spectrum, when it comes to investing, the banking sector has long been one of the most unloved parts of the market, incredibly structurally challenged here in Europe in particular. And now we've seen a massive rally in the European banking sector, a lot of that hinging on the bond market and how we see yields progress over the coming 2 years or so. So what are your thoughts on how we see the yield curve progress here in Europe? And does that make the European banking sector attractive even after the massive gains we've seen in the last few weeks?
Yeah, it's interesting, isn't it? I find myself, reading a lot of market narratives and finding that they're a little bit contradictory at times. And I think European yield curve and the banking sector is probably one. As you say, I mean, SX7E is up, 50% in very short order. That's a huge move. But I don't really see that the business model of European banks, the potential profitability of European banks is necessarily improved. And I certainly think that there will have been a deterioration of asset quality, which has not yet fully been recognized because we've had so many government programs papering over the cracks. If I then go and speak to somebody about their view on periphery and peripheral spreads or spreads in Europe in general, they'll say, well, we expect these to be continually supported by the ECB, which suggests a flattening, not a steepening pressure on yield curves. And that doesn't tend to be good for banks' ability to engage in profitable maturity transformation. So that feels like a bit of a contradiction. I think really what we've seen is that the European banking sector, for obvious reasons that everybody knows about, and then the virus, had got beaten up massively, and so people have taken a shot, and we've seen that reprice quickly. I don't think we're going to be seeing any continuation of that sort of price action. I think ultimately the reality will have to dawn, and we need to work through some of those structural and balance sheet problems before European banks can really truly be an attractive long-term investment, in my opinion.